Hello everyone, I'm Shaleen Agrawal from Financial Express. Today we have with us Narayan Shroff, Director, Barclays Private Clients India. Narayan, thank you for taking out time for us.
Thank you, Shaleen, for having me.
Narayan, as we discussed, one theme which we are very closely watching this year is inflation. Can you begin with a quick overview of what kind of threats and what kind of investment opportunities does it open up for investors?
Yeah, so Shaleen, to start with, when we talk about inflation, let me just spend a couple of minutes talking about our perspective on inflation. And again, at this juncture, the dice on the table, it can roll either ways. But broadly speaking, let's take it before the Russian crisis, Russian-Ukraine conflict started. And if you go back, we were talking about supply side constraints right throughout the pandemic. And that was more to do with, again, supply chain disruptions, across different components. And that got accentuated because of the latest geopolitical crisis. So one part is basically, how long do we expect these disruptions to last, right? So that is what one is playing in the short term. And our thought process is, as good as others guessing on the table as to how long will it last. But, at this juncture, we expect this to taper down. And that is a big call, right? Taper down in the second half to going into somewhere around the first half of next calendar year. That's where we look at the short-term supply pressures, at least weaning off. The other big structural inflationary trend are they basically on two counts. One is, which is also again accentuated by this Russian-Ukraine conflict, is around deglobalization. Now that is a theme which will last for some time, right? And that's a trend which is just beginning to take shape, and that would be inflationary. And the second one is basically that some of the basically energy transition. So energy transition is one of the big themes now. And again, with the oil crisis, the energy crisis, you see that playing out, or again, getting more fuel. But then that also leads to certain types of materials and commodities which will face this pressure in metals and chemical space. So if we take these two trends alone, one would say that we expect inflation to be higher for longer. But the current market expectations in terms of the inflation is overplayed, or it is to some degree overplayed. Again, as I said, in the short term, it's all about how long will this disruption last, the near term. But then our call is that, like I said, it'll taper down. Now, if it tapers down, the short-term disruption, then that long-term trend, inflation remaining higher, can still be played out very well. And there are opportunities which will benefit in the long run, and that's where our longer-term themes, medium to long-term themes, are building up. So coming down now, on the investments, and asset classes, how would it impact?
I'm sorry, before that, you said that you expect inflation to taper down. What gives you that confidence?
No, so as I said, so if the disruptions are because of events,
Yes.
Is the COVID tapering down, the pandemic getting into endemic state, while questions get raised, sporadically, but it is definitely much lower than the last 2 years. And the second one is the other event which is playing out at this juncture. There also, our thought process is eventually it'll taper down, right? So and most of that should have already been priced in, or is being priced in by the market. So from there onwards, it should taper down, right? From the current expectation levels because of these events. Does that answer, Shaleen?
Of course. Please, you were talking about investment opportunities.
Yeah, so moving to the asset classes, and that leads into the investment opportunities. Let me just start by the immediate one, right? One would talk about debt markets, and I'll be specific to, let's say, the Indian debt market. In the Indian debt market now, again, you've seen that with the latest RBI policy, the kind of reactions we've even seen, the hardening in the US rates and so on in the short term. But When one is investing, one has to take a view of at least about a year and a half, 2 years, even in debt markets. So if you go a year and a half from now, let's say somewhere in Q4 of 2023, and there, if we look at what would be the state. So if our current thesis on the inflation part and on the growth part is also intact, is it the only risk is if the growth comes back roaring up, which I don't think is the contention in the market right now. People are talking about recessionary impulses. They're talking about slowdown. All of the policymakers, as well as IMF, have cut their forecast on growth. And we know that the inflation itself will come back and hit the consumers and businesses in terms of both sentiments and spending, right? So if all of that was to come through, it's like a self-fulfilling theory that, ultimately at that stage, roaring growth would not be a concern. If that is not a concern, then essentially we are looking at the rate hiking cycle coming to a pause. So our call is still, as against, let's say a general market, we still believe that the terminal repo rate should be at about 5.25 at best. And that means your overnight rate would be hinging around that, with the corridor being brought closer. Also, why the overnight rate would be around those levels is purely because the other factor is liquidity, right, which drives that. So while liquidity is also going to be tapered off, but we've already had statements in terms of the multi-year approach towards liquidity tapering. So we're still looking at pause with an NDTL plus minus the old adage in terms of, your liquidity scenario. With both these being there, it then boils down, and let's say if the repo rate was to, the overnight rate was at about 5.25, worst case scenario at this juncture. As I said, the only risk is if the demand-led inflation starts picking up. Then we have a different cycle to think about. Then we come to the demand and supply. Everything else on the rates curve is then demand and supply of papers in the market. And there, if we look at it, do we expect the demand supply situation to worsen off from to be worse off from the current levels, or do we expect it to be slightly better? Both in terms of the gross borrowing requirements. In the short term, yes, one would argue saying that part of that inflationary burden may have to be taken on the books by the government. But then even if we take that, there is also that higher income that is coming in and other aspects. One would balance it out. But from a gross borrowing level, it'll be coming down in terms of demand, supply of papers from the government. Also in terms of the demand perspective, that at that juncture, at certain parts of the curve, if you look at from the current pricing of the term premium, which is basically if you look at, let's say, a five-year, and currently, let's say, for example, if you look at across the GSEC curve, if you look at a 5-year, if you look at a, anywhere between 4 to 8 year, is actually trading at upwards of 300 basis points overnight. And that's, if you go back in history on an average, that would be expected somewhere around 150 to 200, maybe max 200 basis points, right? In fact, at a pause level, with liquidity not super tight, which is where you would actually be looking at further hikes, you would be expecting that to come down to somewhere around 100 basis points or so. And similarly, the 10-year at about 150, 200 basis points. But then this term premium is basically what we expect should be coming down. And therefore, the current market pricing throws in decent opportunities across the board. Now, if you go back again, is there similar opportunity available in terms of credit spreads? Not really. That is, we would still wait and watch. But in the next 3 to 6 months is a brilliant time for investors to think through and make allocations. There would be opportunities across the curve as well as across the credit spreads as more supply of corporate bonds come into play and so on. So there is enough to play. If you ask me, last 2.5, 3 years, 4 years, it's actually barring that blip in between. is largely, you had the demonetization, GST, the IL&FS crisis, and then COVID. It's all been safety and liquidity, right? So it's a one-way trade, and that's been overbought. Moment that trade toggles back into a risk allocation, into a duration allocation, you can imagine the kind of shift that will happen. So that's what we are looking at. That's one area of interest, and we have a hawkeye there, if I may say, over the next 3 to 6 months to make those allocations. But one has to always plan for at least 1.5, 2 years, 3 years horizon in terms of making those allocations. The second, if we were to come back onto the equity side of the spectrum.
Yes.
Now, equity side, if you look at businesses, there is a hit or there is a potential hit on all the three counts, unfortunately, of inflation. Now, again, when I say inflation, it's sustaining at the current rate. That is the big question. It hits your top line because of the impact on consumer demand with price rises. It hits on, and if you try to pass on the prices, right? To some degree, it does. And it hits your margins because of your input cost pressures, and then to some degree also embedment in the labor costs and so on, talent costs. So effectively, it hits your bottom line. To the extent, there we look at opportunities where businesses are able to pass on these. And we've seen that in earlier cycles as well. And in all stress situations, good quality businesses are able to pass on, right? And then the third one is in terms of the valuation. So the discounting rate, which is used in terms of valuation of. But all of these, as long, like I said, our base case is that it should eventually taper off from the current levels. As long as that happens. So even if you look at the curve, you typically see that the impact is more in the near term. I'm not talking about now the bond markets, but let's say if you were to look at from an OAS markets and others and try to see as to what the market is gauging, everybody is worried about it being sharp, quick, and steep in terms of the hikes. So if you're modeling and trying to model or discount cash flows for the next 10 years, 15 years, 20 years, and so on, your impact is on the near-term cash flows, right? The highest, but it's not in perpetuity. So at some stage, if it goes and then comes back, again, it gives us a good opportunity. Market is giving us cheaper in terms of discount rate. So we would go back and again take that call. So our base case from that perspective, yes. Where we see a huge risk and we again are very, very cognizant is basically where or which sectors and businesses where we see this risk being high, right? Ultimately, we are risk allocators. So as risk allocators, one has to see where the risk is high. So wherever it is, the impact is highest in terms of top line and bottom line. That, we are currently in the near term, we would try and avoid, right? And where we see it to be able to pass on, it becomes a cheaper bet. But within that, then the question comes to valuations. So sorry, I'm just, maybe moving a bit ahead, but then just playing from there, one goes into the valuation side. So let me straight away, I think, like I said, it's all about route to market. So you may have a brilliant team. We have those, top-down views. How do we articulate in terms of opportunities? And at times you actually transcend through these pressures, believe you me, and that allows you to take brilliant investment calls. So I'll come to some of the themes. So in terms of positive themes, and these are structural themes. When I say structural, all these headwinds and maybe 2 more may come tomorrow, God forbid. But then, these themes should sustain those. So the first one is, of course, the IT, the digital IT space. Now, there are 2 parts of IT, we all understand. The one is basically more defensive, but within that, there are players which are working very well. That's the IT services space that we're talking about. And there's a big order book growth, big demand growth that is there, despite the qualms around, the slowdown in Europe or slowdown in US. There's a big demand growth happening there.
We're talking about here the traditional IT companies such as Infosys and TCS.
Yeah, the traditional, IT services company.
Sure.
And then we have the new age digital, and I'm still not coming to the platforms and the new age loss-making companies. I'm still talking about the new age, as in the product companies, the SaaS companies and others, but then in the new age space. And there is a big growth engine there as well. And within that, it's being played through some of the mid-cap IT companies as well. They have very specialized solutions where they are growing. They have got brilliant talent that they are able to retain, as well as the new age companies, which are, more, I wouldn't say startup, but late stage companies, which are coming up in the market. So selectively, there is opportunity in both structural growth as well as defensive growth. When I say structural, I mean the underlying theme itself in a structural, multi-year structural growth market, and then the businesses which are able to then redeploy and grow within that space. And similarly on defensive, the underlying market is a bit more matured state. But then the companies themselves, or the businesses, have been able to and should be able to grow on a compounded basis and redeploy their profits. So I think that is there in IT. The other big theme, which can be actually a decadal theme, it's about how it plays out, but for sure, is the green ecosystem, right? So within the green ecosystem, it's very difficult to kind of pin down as to where investors would make money. It's a good theme. It's brilliant. It's been highly talked about. A lot happening here. But then, how do we make money? So I think we are looking for opportunities again and again. But then there are three parts to it. One is the big boys game, right? Which is the energy itself. Sure. So energy production, which is the big boys game. And we have, some plays or some businesses which have executed and should be able to execute these plans in a scalable manner. And we are quite bullish on that. Then you have the e-mobility space. Again, a lot being talked about around that. But then there are different parts of that business, right? So it goes right from consumer is what comes to mind, but there is also the commercial side of it. There is also the logistics side of it. There is also the tertiary side of that business. And that's going to throw up a lot of opportunities. And the last one is also in terms of the chemistry part of it, again, the startup, the R&D and all of that. That, again, is not, if you ask me, investable, but then the tech part of it is still through the private market. So it's across the board, but it is a huge decadal theme that we will continue to hunt for opportunities and continue to size up our allocations there. It's all about conviction and sizing up, right? That's what makes the difference. The next one is materials. Now that's very common. So within the material, the traditional energy / oil, gas, and all of that is what we are avoiding.
Okay.
Because we feel that they're not efficient capital allocators, unfortunately, the ones which are available in the market. We like the metal space. We continue to participate. It allows diversification, allows us to hedge our portfolio in the cyclical space. We continue to participate in cements. We continue to participate in chemicals. And chemical, the space is getting wider and wider, right? So all these material spaces definitely we continue to remain bullish and allows diversification within our portfolios. And the last piece is basically corporate banks and financials, as in the larger NBFCs. In fact, the corollary of that, the retail banks, is where we see a lot of headwinds. Right, sure. They're facing headwinds in terms of the extreme competition. They're in terms of new age, old age, cards business, retail business, and so on. And also on the consumer side, right, there is a deep down pressure, in terms of the inflationary impact that we just spoke about. So that will also be a headwind. And the last piece is, of course, in terms of the regulatory requirements, right? All of that is headwind. So retail banks is what we are avoiding. We like select corporate banks, which have a good growth path, and more so NBFCs, larger NBFCs. NBFCs, can play through the CV segment, through different specialized areas, but there are decent growth path there, and they have less of a load when they grow. And we've come a long way. after the NFS crisis. So things are opening up.
No, so I was just saying telecom, we are neutral, but we do like as an allocation, as a diversifier in the portfolio, there is room for expansion in terms of ARPU and overall growth, because it's consolidating from all the headwinds it had. But the limited participation opportunities, so we're playing through diversified themes. But then coming to the sectors that we are avoiding at this juncture, we are underweight there. There will always be selective opportunities, but then retail, I mentioned retail banks, and also consumer discretionary for the same reason we discussed earlier about the pressure on top line and bottom line is the highest. So while they are able to pass on the prices, some of them would still be there. But at this juncture, because of our relative conviction over the next 12 to 18 months, we don't feel that the clients need to necessarily build on too much of defensives. And therefore, pharma, which also has generics related US pressures on pricing and so on, right? So the pharma and consumer discretionary, I mean, just as a defensive play, or even FMCG, we are very, very selective and less of an exposure, because ultimately it's like building quasi cash. So there is a bit of diversification, but not too much of it.
I have a very quick follow-up on there. A consumer discretionary, for the longest time that I remember, I have been reading that India's economic growth will be driven by consumer spending. Consumer spending is set to be set to rise to 60% or 70% of India's 5 trillion economy goal. And here you're saying that consumer discretionary is a space where you are selective. How does that reconcile?
So the near term, see, one is looking at from a near term perspective at some price, and at a stage, let's say 3 months, 6 months down the line. Like I said, in the immediate term, as an equity investor, I would want to avoid, I have other choices to make allocations to, right? So I would want to avoid where I see, I'm a risk allocator. So I see a higher risk in the near term. Is it from a structural perspective a question mark? Not at all.
Okay.
Absolutely believe in that. I mean, if you're going to have a services digital growth, and then you have the CapEx revival, which is a big one that we are playing on, right? It can be delayed because of what we are, going through in terms of price pressure, consumer pressure, sentiment. It can get delayed by a few months, but it's not derailed for sure. And that's coming back after 7 to 8 years. So both the cycles, and then we do see some impact on the risk on the agri side, because there are pockets on agri or rural consumption, which is also getting impacted. All these are near term, but if we sail through it, then, and if you have the three engines working, both domestic as well as exports, then we have that consumer has to come into play.
I also had a follow-up on the earlier part of the tech companies that you said, the structural tech, the structural changes tech companies. In the US as well, that discussion is very heated right now, where people are discussing whether so-called growth companies still have it in them because of the interest rate hikes to give those kind of returns going ahead. Do those same concerns persist here in India as well? Do these high growth companies have a chance in the in high inflation and rising interest rate scenario?
So yes, see, the concerns are coming more around the rate hike as in the discounting factor for the cash flows. These are heavy cash flow companies, and so ultimately you would try and value that through a cash flow model. In US, when we talk about our Western markets, a lot of these businesses have actually gone through those cycles and are actually profitable and generating a huge amount of cash. So in the short, but in India, I mean, it's a mixed bag, but mostly it is loss-making early stage. So people are envisaging that they'll basically move to that stage. But that story is going to continue. In terms of valuation corrections that were heating up, and therefore from our client's perspective, I think the so-called late stage and pre-IPO market, we were very, very selective, because it's a game of experts. One has to go dig down deep and take a multi-year approach. And that's how we participated. We'll continue to participate in that. In terms of the toggle in valuations, these healthy corrections would ultimately lead to perhaps an opening up of a new era where a more saneful participation from investors will continue. And that toggle will happen when I said this short-term supply side inflationary concerns comes down. Same thing that we discuss about debt market, same thing that we discuss about equity market valuations. Ultimately, if it has to come back, where will it come? It'll have to come back in technology, right? As in the technology plays.
Sure.
So that toggle will be made then, and we would also participate.
If I understand this correctly, if I'm hearing right, are you saying that in next 3 to 6 months, investors must go all in because this is the window of opportunity?
It may happen. So one needs to be ready. And that's what we are always. But I'm saying, yes, the opportunity may present itself. We're just starting to see, a bit of an overshoot on concerns, right? And that's the best part. I mean, when the world is fearful is when then long-term investors jump in.
Yes, I like the phrase that you just used for that, saneful participation from investors. I have a procedural question here. You spoke about risk allocation. For example, you spoke about consumer discretionary is not in the favor right now, but going ahead, maybe, definitely. Then doesn't it make sense to start allocating to that sector right now rather than trying to time the cycles and have little allocation to it now and then maybe reaching the allocation later in about a year or so?
That trigger is unfortunately not in my hand, right? Or our hand when I say as an investor community, because that ultimately the unknown at this juncture is how long will this conflict and therefore the disruption last. And as we you will not get full clarity ever. And that is when one gets a risk-free return, right? So you have to take certain risk, but a calculated risk. So therefore, we want to be in that position where we can take a calculated risk that, yes, that pressure is coming off. At this juncture, with so much of volatility, risk-adjusted allocations is just not making sense. Maybe a few months down the line. Now, when I say I don't want to paint the entire industry with the same color, for example, and again, one of the bigger consumer discretionary is autos. So within that, I talked about e-mobility separately.
Sure.
But then if you were to talk about generic auto, you have the headwinds from the e-mobility incumbents. You have significant supply side constraints in terms of supply itself. And now the price of supply, which is the input cost as well. So a lot of headwinds are coming in. And this was there even before we came in through this new set of restrictions. So ultimately, at some stage, they may become cheap enough, but then they would compete with other ideas or other themes that are there in the portfolio. We don't need to have everything in the portfolio. It should make tremendous sense. I would rather get over with this immediate uncertainty and then take a 2 to 3 year, 5 year, that $5 trillion economy, and then the per capita income going up and so on, right? So that story is still intact, but then we have to sail through this. So I mean that equity investments, nothing is running away as long as we have a long-term horizon.
How long-term is long-term?
Long-term for equity investor, it's forever. I mean, it's about your investment horizon as to when you want to. An equity investor should just keep investing. I mean, in terms of asset allocation, once you've made allocation to equities, you just keep allocating to that. Tactically, we are overweight on Indian equities as well as global equities.
Sure.
Yeah.
And do you have a view on the headline indices? Where would those be in 1 year, 3 years, 5 years?
Sorry, for?
A view on the equity indices? Market levels?
No, we don't publish those.
I understand.
But having said that, do we expect, I mean, the reason why we are overweight, because we do believe that in the next 1 year, 2 year, 3 year, that one would be able to get much better risk-adjusted return compared to debt or fixed income. And that I'm talking about a healthy risk premium. And that's based on both the overall market that we take a top-down view, but more importantly, the businesses and the themes that we are looking at. That gives us more confidence. The last piece that I wanted to also one of the other asset class, because we spoke about the opportunities that may present itself in the flow fixed income market, but then a structural opportunity also exists in the high yield and structured credit markets.
Sure.
So that's been displaced, and that we continue to believe, and that typically does very well in a high inflation scenario, because unlike a normal debt which faces pressures, the high yield and structured debt relatively stays stable. And we've gone through a lot of disruptions. So that's another area. All the disruptions, again, from demonetization to pandemic, has actually led to this sector being ignored. So highest amount of demand and quality demand, and lowest amount of supply. So that is another area.
The high yield a paper, not very long ago, investors discovered that the risks associated with those high yield papers, in case of one of the famous banks, so do you think it's still worth that kind of risk? I mean, if I'm willing to take that kind of risk, then why not equities directly?
No, absolutely. But there is a play of all asset classes coming together. There's a diversification benefits. That's the only free lunch in the market. But having said that, and absolutely, that's the reason why I say, see, every time you go through risk, I can explain to an investor for hours on paper and PowerPoints, but it'll not be understood. But once you go through it, is when you understand. So I think the market had discovered that. And it was not just a question of the underlying risk. The underlying risk is actually not bad, even if you look at the kind of recoveries in those. So you have to look at a diversified portfolio. And you have to look at good managers who can do their diligence and good job. Once you have that, it's not been bad at all, even through those cases. The method in which those investments were made, the vehicles through which it was made, with liquidity, with return, the kind of investors who were taken into that made the difference. So I think as long as it is done with the right earnest, with the right vehicle, and with the right mandate for discerning investors, and if you do it in a managed basis where you have professionals managing the risk and in a diversified fashion, it can be a nice diversifier and a good risk premium one can derive from that.
And if you have 5 more minutes, I would like to talk about 2 quick things.
Yeah, sure.
How much allocation do you think does it make sense for Indian investors now, high net worth individuals, to put into the US equities vis-a-vis Indian equities?
See, in terms of allocations, typically it depends on, again, the risk profile and asset allocation overall. But in a general, let's say a balanced profile investor, one would expect that about a 20% odd should be to foreign equities. Now, it happens to be that most of the opportunities or good opportunities, quality plays are available in US. Doesn't necessarily mean that the underlying exposure in terms of the business exposure is within US. So, but it should be a global approach. And I would say to a global equities, one should be at about 20 to 25% exposure for a balanced kind of a profile. And that's how one would look at it. Do we have investors at those levels? Not really. I mean, it's easy talking about it. It's because of the current set of vehicles and tools that one has. And again, route to market becomes critical. But I think in the last 2 years, post-COVID, we've already seen that market jumping up quite a bit. And that's really healthy for the investors and for the wealth creation in the country.
Someone who's not your client right now, other than approaching you to become your client, how should that person do their portfolio allocation right now, keeping the uncertainties of next 2-3 years in mind, and at the same time, their long-term objectives of 10 to 15 years in mind?
Shaleen, unfortunately, I'm bound by my compliance standards not to be able to advise to somebody who's not our clients and have not signed up for it.
Yes.
But I would just perhaps just say that
I imagined this entire interview was about that, so that our audience can gain from your experience and your interactions with your clients.
Yeah. But see again, I can talk about individually as to how it all comes together is only when I know a client or we know and understand the client's profile, and as they say, KEU, which is knowledge, experience, and understanding. It makes a huge difference in how one allocates. But broadly, if one was to say again, the one common theme that one should keep in mind is that for every additional piece of return, unit of return, one has to have a higher appetite for risk. So one should be doing one of the two: either bring your expectations down in terms of returns, or build your appetite for more volatility. And that, again, as I said, I can talk about it, I can write it on a paper, but it's very, very difficult. So the way you build that appetite is by going through it. So, on the increment, one has to start taking a bit more risk, take it on a staggered basis. And that way, once you go through these volatility, which has become more common found now and should be going forward, one will build that appetite, hopefully.
One last question. If you can, is there a number in mind? A reasonable investor with a reasonable appetite for risk, how much return can one reasonably expect from the markets, a mix of asset classes over the next, let's say, 3 to 5 years?
See, I would say, let's look at it from a different perspective. Let's see how much should be enough for an investor for taking risk in the market, right? So what is your base? Your base is basically your inflation. And depending on the, an investor, that retail inflation, which is published, may not necessarily be the inflation. We can debate that, but that is a good benchmark. So if one was to look at a long-term inflation in a country, growth country like India, at about a 5% handle, although RBI talks about 4% plus minus 5%, but the 5% we know is the long-term maximum potential. So if 5% is your inflation handle, the expectation of with a decent risk allocation that you mentioned, or risk appetite of a client, and I'm assuming also knowledge and experience, should be at least about a 5% point over and above that in terms of risk premium.
Sure.
Right. So that should be the case. Now, of course, after that, it is all about active management, people being able to generate alpha, but generally from the market, an expectation should be at about 10% odd. But again, it'll go through its set of volatility. That's what, so moment you, set your target at 10%, it'll be impossible for one to go through that volatility, because, you always expect that to come in 1 year, may not.
Yes.
2 years, and so that's the whole piece. But that is what I would say should be the base market return portfolio expectations. And then the rest depends on how much route to market experimentation, how much sophisticated products and risk exposures one can take, and active management alpha.
Narayan, when we meet next time, either I'm in Mumbai or you're in Delhi, we'll talk about two things. One is those routes to market that you so love to talk about. And another one was risk on paper with PPTs and all the explanations that you can give us.
Yeah, sure.
Narayan, thank you so much for taking out so much time for us today. It was a pleasure talking to you.